Now let's look at how people make economic decisions. Traditional economics assumes we're rational decision makers, weighing costs and benefits logically. But social psychology shows that emotions, social influence, and cognitive biases often drive our financial behavior. Have you ever bought something because it was on sale, even though you didn't need it? Or kept investing time or money into something just because you had already spent so much? That's human decision-making, rarely purely rational. We're influenced by loss aversion, sunk costs, and social cues more than we realize. Money doesn't just buy things, it changes how we think and feel. Priming people with money makes them feel more independent and less socially connected. In one study, participants who handled cash were less likely to ask for help, solving a tough puzzle, even when they were struggling. Money triggers a sense of self-sufficiency, which can be helpful in some situations, but it can also be isolating. It's why financial stress can affect not just our bank account, but our relationships, our health, and our mindset. In an experiment, participants excluded from a group game felt less distressed if they had previously handled money. The implication? Money can dull social pain, offering a kind of psychological armor. But this comes with a trade-off. It can also make us less connected, less empathetic, and more transactional in our relationships. So money creates a buffer, but sometimes that buffer keeps others out. The stock market is supposed to reflect economic fundamentals, but it's also heavily shaped by emotion and social cues. Fear, rumors, groupthink, and even TV analysts can move prices. Think of the GameStop surge or crypto spikes. Much of that behavior was driven by online buzz, Reddit threads, and social identity, not just company performance or data. It shows how easily markets can be swayed by collective psychology. Investors often overreact to trends and misread random fluctuations. One common bias is the endowment effect, overvaluing things just because we own them. If you've ever tried to sell a used textbook and felt insulted by how little someone offered, that's the endowment effect. In the stock market, this can lead to people holding on to bad stocks, not because of logic or evidence, but because they believe in them emotionally. It's one more way our psychology influences our financial decisions. The escalation effect describes how people keep investing in failing projects to avoid admitting defeat. This is driven by what's called loss aversion and feelings of personal responsibility. Think of a company continuing to pour money into a doomed product just because they've already spent millions on it, or someone staying in a bad relationship because they've been together for decades. It's hard to walk away when you've invested time, money, or emotion, but sometimes that's the smartest move. Smart decision-making means ignoring sunk costs, which includes things like past time, money, or energy that can't be recovered. But that's hard. Think about continuing a Netflix series you dislike just because you already watched 5 episodes. The rational thing is to cut your losses, but human psychology resists that. We need to learn to make decisions based on future benefits, not past commitments. To wrap up, business decisions, from hiring to leadership to investments, are deeply shaped by social psychology. Whether you're applying for jobs, leading a team, or managing your finances, understanding these principles can make you more effective and more aware of the forces influencing others. The world of work is not just economic, it's social.